if we get a pullback and a good correction in the stock market, they'll come down. But then they'll be the first to rally. And if the market continues down, gold's the most negatively correlated asset to the stock market. So at some point, not day for day, tick for tick, but general trends are there. You'll see gold actually do better. I actually think we'll see a new high in gold by then. Not anything like $200 more than its old high. And I think silver still, as much of it's been beat up this year. I think 26 something was the high in early May. But regardless, I think you could see, better prices for silver as well. This time around, it looks like gold's got to take the lead before silver will come on.
In a recent interview, David Morgan of the Morgan Report made a stark prediction about the future of the U.S. dollar. According to Morgan, once the Federal Reserve decides to reverse its monetary policy stance, the dollar will find its place in the dustbin of history. While the Fed paused its rate hikes last week, their hawkish rhetoric continues to echo. Morgan's analysis suggests that gold is poised for a strong performance when the stock market undergoes a correction. On the other hand, silver might follow suit, but could take some time to catch up. This view aligns with the growing sentiment among analysts, who have turned notably bullish on silver. One noteworthy observation is that silver has been outperforming gold lately, as evidenced by the decline of the gold or silver ratio from its recent high of above 84 points to below 82 points. Despite gold's somewhat lackluster performance over the summer, Société Générale remains optimistic, projecting a potential path back to $2,000 per ounce. However, the silver market has seen some turbulence at the start of the new trading week, retracing to familiar lows after a brief bounce last Friday couldn't be sustained. This volatility comes as Federal Reserve officials remain divided on the future of interest rates. Despite voting to hold the benchmark rate steady last week, 3 policymakers expressed uncertainty about whether the battle against inflation has been won. In the grand scheme of things, David Morgan anticipates that the Fed won't be easing anytime soon. When they eventually do, he foresees a substantial uptick in precious metals. Before diving into David Morgan's insightful interview, subscribe to our channel and give this video a big thumbs up.
Gold usually hits its low in August, which was close to this year. And then it's not an immediate September 1st. It starts coming back up, although generally speaking, the last quarter of the year is generally good for the gold market. I think what's going to happen is we've got this purported end of money for the U.S. government by the end of September. I haven't looked into it real deeply, but I've got it from good sources. So if this is true, there may be an emergency meeting of the Congress critters to, fund the government again. Regardless of whether any of that takes place or not, I do think and have been saying for some time, and, I could end up with egg on my face, which is fine, that October we would see some kind of market shift in the equity market. So if I'm right, when we see equities come down in a substantive way, then gold and silver will follow or all come down at the same time. That's because there's so much leverage in all the financial markets. Everything's basically computer programming with algorithms and AI. I mean, the Aladdin program that works for BlackRock, a lot of people don't even know about it, but it's been running the show for quite some time. So the idea is that I expect to pull back and everything. So I think the gold and silver market may just kind of be biding time until a clear direction is given. For example, I'm correct and they get, pretty sharp spike down, or I'm wrong. And, maybe the market does better than I expect and the gold markets and silver markets start to move up. Any increase in interest rates is very detrimental to gold. That's not true. Gold goes up in an increasing interest rate environment for quite some time. And the only time interest rates really take power over gold is when you have a real rate of return. And if the real inflation rate's, say, 7% and you're only at 5.5%, then you're actually still yielding a negative 2% or so in real terms. So until you get a real return rate, then it can have an effect on gold. But there's so much funny money out there now that even if it did get to, say, par, we got to 7% interest rates. I'm not saying we will, but if we did, you'd still be break even, which is better than losing 7%. But so it will have some effect on a knee-jerk reaction, but over time, you'll just see gold continue to march up and up and up. So again, I think it'll be higher by the end of the year. The Fed is doing everything they can, not only in real terms, meaning they are increasing interest rates, but is also the rhetoric. And you'll see them start to shift more and more, meaning that they're going to retarget. The 2% won't be the target. They'll modify it and say, well, really, under current conditions and the supply chain and the illness we had, and they'll make some excuses and they'll say, we're going to shoot for, pick a number, 3%, maybe 4%. I really think that the gold markets will take off, silver as well, when they throw in the towel. When the Fed says, well, we've already printed umpteen trillions of dollars over the last couple of years, and we are seeing inflation now, but the economy is so bad, we're going not only to pause, we're going to cut. I don't see that happening for a while, by the way, but at some point they probably will. And that's sort of a signal to the markets that they've given up. They've given up a tight monetary policy to defend the value, the worth, the price of the US dollar. And they're saying we're just going to let it go into the dustbin of history like all fiat currencies have. When, if that takes place, and I'll say more like when, it won't be instantaneous. But within 3 to 6 months, the markets will understand that they've given up. There's no hope alive that this dollar will last in its current form for much longer. And that's when you'll probably see the metals markets really, really move.
In economic policy, a contentious debate has emerged around the principles of modern monetary theory, which posits that central banks can address economic challenges by purchasing substantial amounts of government debt and expanding the money supply. However, critics point to historical evidence that suggests a scary outcome for economies that have embraced policies reminiscent of MMT. In numerous instances, this approach has led to hyperinflation, widespread social and economic turmoil, and, ultimately, a crisis. This pattern has played out in countries such as Venezuela today, Zimbabwe in 2008, and many more. One prominent voice in this discourse is DavidMorgan, who raises concerns about the seemingly unlimited printing of money without any backing, a core tenet of modern money theory. While Morgan does not endorse a return to a gold-backed monetary system as the immediate solution, he underscores that it could become viable if alternative proposals fail to address the challenges.
There's been a bigger and bigger bifurcation between China and the United States, and we, the U.S., really depends on China more than most people know. I mean, if China stopped all shipments of everything they produced, Walmarts would be empty, for an example. Xi is not the only one feeling hard done from the U.S. sanctions, as President Putin confined to attending via virtual phone call to the last BRICS meeting in South Africa. So Putin's really calling out the U.S. administration for talking out of both sides of their mouth, trying to make things sound benevolent and good and caring and loving and, all of that, when in reality, it's anything but. And I don't care where you stand on the Russia, Ukraine, what side you're on. Hopefully you're neutral. But regardless, you got to look at all and then use discernment. It's sort of the Bruce Lee method. Look at everything. You can learn a lot of things you don't want to do, but you can also pick up things that you do and incorporate them for you yourself. And that's, the way I look at the geopolitical world is pretty hard to navigate through because almost everything you hear on either side is propaganda only. You really don't get much truth. A theory that record-breaking central banks gold purchasing activity supports. In other words, central banks have been buying gold at a record rate last year, continue to buy at a rapid rate again this year. And I have a slightly different take that gold is the money of last resort, but it's also the last thing on the table in my view. I don't think the new system will come out and say we're gold backing the new one world currency or the dollar or however it goes. I don't think that will happen. I think they'll put up something else and try to fool the public one more time. And if that doesn't work, then they'll probably bring out the gold card. After studying what Mark Carney said when he was working in the Bank of England before he left, and gave the same speech in 3 places, and it all basically said they wanted a modern money theory, which means unlimited printing, no backing whatsoever, and they wanted complete control. They wanted to eliminate paper currency altogether. So they wanted a cashless system controlled by the banks only, and everything you did was trace and tracked and taxed by them, the central bankers, and no backing. So that's what they want. And as I've said before, and it bears repeating every time, and that doesn't necessarily mean that's a place, but it is probably what will be their first proposal. And if they can get away with it, they'll probably do it. If they can't get away with it again, they'll probably have to come back and make some kind of bridge to gold or, some backing. The problem with backing it with gold is it's the old system that the gold standard never works, and it's not because the gold standard doesn't. It works wonderfully well if it's adhered to. It's just that, is there, really the gold in the vault, and is it really backed and all that? And that's why, of course, the U.S. shut the gold window on August 15th, 1971, because we lied. The U.S. printed more receipts for gold than there was gold to collect, and France and the U.K. called them out on it. So they had to close the gold window. Could that happen again with the blockchain and the smart contracts and all that? There's a lot of arguments of no, wouldn't, couldn't, shouldn't happen, but I'm not so sure. When the human element is involved, a lot of funny things.
Central bankers, in particular, have expressed interest in modern money theory with its unbridled money printing. Yet, as the debate rages on, the question of which path to take in shaping economic policies remains open. What are the potential advantages and disadvantages of returning to a gold standard in modern economic systems, and how might it impact global financial stability and trade dynamics? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.